One of the most common comments I get, especially by younger people, is that just buy the dip. Every time the market drops, just buy the dip, you'll get rich. Well, there's an article in the Financial Times that talks about why investors should be cautious of buying the dip strategy. It's interesting. The article goes on to say that people think buying the dip has become more and more frequent, so just buy the dip and it works all the time. But the article points out that buying the dip is spot on over its long-term average, about 25-year average. A couple of times a year, you'll see a V-shaped recovery. Where you really get hurt is during those massive bear markets like 2000, the dot-com bubble, 2008. 2000, if you remember, the market had gone up from 1982 to 2000. In 87, we had an 18-month correction, but that was a correction in a long-term bull market. By 2000, the market had topped out, and by March, the market slowly went down over 3 years. If you'd have bought the dip, it would have led to financial ruin. The same thing would have happened to you in the credit crisis of 2007 to 2009. If you'd have bought the dip, you'd have been in, it's a wealth-destroying strategy. And I think it's a very good point that young people need to understand. There's a famous quote by John Maynard Keynes, Keynesian economics, one of the most famous economists of all time. He says markets can remain irrational a lot longer than you can remain solvent. And trust me, you don't want to be in a financial ruin situation. Our attitude at IPS Strategic Capital is simple. In fact, Dr. Nassim Taleb, one of my mentors, says if you're invested in the stock market and you don't hedge, you shouldn't be invested. So it's not a question of should I buy the dip, should I not? Just be always long and hedge because you don't know. Thank you for listening.